Welcome to Real Estate Accredited, where we go over the nuts and bolts of real estate investing. I'm your host, Jeff Rodriguez, joined by my co-host, Philip Schuligan. We are founders of Boost Capital Group, a real estate investment firm where we help busy professionals invest in real estate investments. Today, Philip is going to go over exit strategies of multifamily investments. So, Philip, please take it away.
All right, thank you. And also we mentioned of our latest addition to the team, Chris, who couldn't be with us tonight. So exit strategies for multifamily investors, maximizing returns and minimizing risks. That's the topic of today. And as usual, our focus is on in-place commercial multifamily with a value-add strategy. So, most of what we talk about is geared towards this particular asset class, and business plan. However, we also cover other topics. So, I think why we wanted to talk about this topic today is because it's a very critical part of the value add strategy, the exit, because that's when you're going to capture most of the returns in general at this position. And that's why it's something that to be really thought about thoroughly and considered on a regular basis. But we're going to go over the specifics in the coming slides. So what are the factors influencing the exit strategy selection? First, market conditions. And as you should know, you probably know, economic and market trends that are going to influence basically your exit and also the choice of the exit. And in a sec, we'll go over historical cap rates and think about different scenarios there. That's basically markets and the economy that are going to have an influence on prices in general. Prices are reflected by cap rates. And there are periods of time where cap rates are going to increase, meaning that the values are going to decrease if we follow the formula here, and vice versa. So it's important to understand where you stand in the economic cycle and then make the necessary assumptions and necessary plans to take that into account. Number two, the investment horizon. So in value add, you're going to come with typically a 5-year hold period. And now you're going to assess on a regular basis, is it a good time to exit? Are we achieving the target returns? Yes, no. And what's the market trend? And then you can make a decision at that point, is it a good time to exit or not? Finally, another consideration, the impact of the property's operational performance. If you are, let's say, in a good place with the property, your net operating income is high, meaning that the value is going to be high. Again, like going back to this cap rate formula, that's a good time to sell. Now, if you have difficulties with your property, occupancy is low, and that's actually the case. Exactly that case happened last year when we decided to sell the property. Shortly after, I don't know, is it a coincidence or not, the property started to do less and we started to have lower occupancy. We went as low as 80%, and really at that point, the net operating income was pretty bad, and it was not a good time to sell. It was a terrible idea to sell in that context because, again, if your NOI is low based on the cap rate formula, your value is going to be lower as well. Like the buyer is not going to pay as much. Let me know if there are any questions. Otherwise,
What city was that, Philippe, please?
was that
What city was that where the rent started going down because the
the,
vacancy?
no, it's the occupancy. It was in Memphis, but that was not market related. there was a little bit of a management issue temporarily.
Mm.
We're at 100% right now. So I beat up the PM and they delivered. So
That's
it's
great.
called asset management and no need for software.
Should I send bandages?
Yeah. So here, just to carry on the thought of market conditions and forecast, I came across this very forecast, and because I was looking for a more historical cap rates for multifamily, and it was interesting because not only it's showing a pretty long history since 94, so now it's 30 years worth of data, but also a forecast. And it's interesting to look at the future from that standpoint, the forecast, and it is something, actually the chart is dated from sometime last year. But indeed, if you look at the current cap rates, they went up quite a bit. But at that time, they were considering like 3 different scenarios. And I think this is also something that you may want to have in mind. Maybe there's a base scenario and there's a worst scenario. That your base scenario is the dark blue here. The worst scenario is the orange line. And it's part of stress testing your exit in that case and changing the different, seeing what's the impact of a different cap rate on returns. But going back, it is good practice to consider a cap rate expansion at purchase. So you're going to say, okay, my market cap rate is at 5%, for example, and you're going to assume that there's some kind of downturn. And in order to do that, you're going to increase your cap rate for every year you're holding the asset of, for instance, 10 basis points, 0.1%. But I think at the end of the day, let's say you're buying here, right? So at the end of 2008, and you've increased, so your hold period is 5 years, and you've increased your cap rate of 50 basis points, you're going to be a little below the actual line. And I think here it's even worse. If you're buying
Do
it.
you wanna go over like the 10 basis points, what class we're talking about here?
Yeah, sure. 10 basis points, that would be more for, let's say, class A in general properties or class B, but also class A or class B or even class C, but in a very compressed market cap, I would say, market cap rate. Otherwise, you may want to consider a little bit of a higher cap rate expansion every year in order to cover your basis. But again, like this exercise or being conservative on the exit, is going to cover you to some extent, not in any situation. Because again, if you're buying here and the reality is that cap rates are going to go as high as here, which is probably reality right now, even if you increase of 0.2%, there will be a gap between the reality of when you're going to sell and in the reality of the market at that point. I hope that makes sense. So next, let's look at the exit strategies and other considerations. As I mentioned earlier, selling the property, that's how you're going to capture most of the returns on your investment when you do a in-place multifamily value add. So it's a very important milestone, obviously, in a value add strategy. Now, obviously, you have, and I think timing the market maybe is not the right terminology. Yeah, it's more sell it at the right time at that point, right? Timing the market was before, like when you're forecasting and trying to make some projections and so on. But now you want to sell at the right time. And let's say you have increased the cap rate for exit, and let's say now the market is such that cap rates are really higher and you cannot achieve your returns, maybe you want to hold on a little longer. And vice versa, right? If we go back here, let's say you plan for some kind of expansion of cap rate, but really it went dramatically down, maybe you sold after 2 years or 3 instead of 5, because now you can sell at and make all the returns that you expected, but in a much shorter period of time. And that's also very important. You don't want to be, greedy, for lack of better term, and hope, look at this trend. It's been going for years. Eventually, the music stopped and some were left with no chair. If you know that game with that,
Musical
you
chairs.
the chair, musical chairs, exactly. So, right time doing, you hit your returns, or even better, or a little bit better. That's the right time to sell, because now you can deliver. You're doing better than expected. Everybody's happy in a shorter period of time. That's terrific. Now, the last point here, selling the property, you have to prepare for the sale. And that's something will be discussed in the coming slide as well. So I don't want to spend too much time. Second strategy, which is obviously not really an exit strategy in that case, if you do a refinance. But what's interesting with that thought is, and sometimes I'm not talking about the refinance as being part of the business plan in that case. I'm talking about a scenario where you are at the end of your hold period, and now you realize that thanks to the capital, like the value you created in the property, you could cash out the investors, do a refinance, and basically stay in the property and do a long-term hold in that case. And because you return all the principal to the investors, they have infinite returns on their initial investment. So that's an ideal, perfect scenario that fits some investors. The con to that thought is that you're not going to generate all the returns. And really, I should have maybe prepared a little chart and make some comparison, maybe for next time.
There's a comment, Paula. Much of the choice of when you can choose to sell depends on how the original debt was structured. So if it's a good time to sell and the debt was structured with prepayment penalties, as long as the sale covers and investors still make their money, that's obviously on the buy. Your exit strategy is being affected later on down if you get out earlier when you have a good market to sell. So all those things considered.
See a comment from Paula. Many of us as LPs had investments where GPs refinance year 2, but then market interest began to be so fast. Instead of giving best money, they invested our gains into the builder. Yeah. After,
We
that's
got to read those company agreements to see what we agreed to. And if we agreed to that, okay. But when you get $600,000 as a windfall on one property rental alone, and you don't get anything back, it's okay. We're not getting that back. That's we didn't plan on that, but we have to suck it up. That's what we have to do.
Yeah. And again, see, this is a little bit of a different discussion, because now you're talking about a refinance being part of the business plan. And no, and that's not, and I think also like the exit strategy, another consideration is, when is your loan coming due? So now that's another factor that you have to take that into account, actually, in your thoughts about selling and assessing the sale, and etc. A couple of other considerations, I would say, and I guess it's going in two different directions, really, into these 2 bullet points. But 1031 exchange is a variation of the sale, or let's say like an option in the context of a sale. And so for people who are not familiar with, 1031 exchange allows you to not pay taxes on the profits that have been made on capital gains. And really, I think that's an important keyword to understand. It's like the benefits of that, what you're going to achieve is just to defer to later on your capital gains. Now, I've heard of strategies where you're postponing that for forever. It may make sense for your personal situation. But something to understand is that you're deferring, you're not avoiding altogether. But anyway, so you will not have to pay taxes on your capital gains thanks to a 1031 exchange. However, in the context of multifamily, especially a syndication, that would imply that the same group of people who are investors in a particular deal, they would have to go as a group collectively in the next deal. It's one of the limitations. That's why, which by the way, in that case, the idea is to reinvest in another property, right? Because 1031 is one of the features. It's a like-kind exchange, meaning that you have to stay within, if you are in real estate, you have to stay in real estate. And that's how one of the constraints there. And one of the options, if let's say the sponsor is going to offer, I want to do 1031, and we're offering a 1031 exchange, but not everybody is interested. So in that case, there will be a partnership buyout, and whomever wants to get out at that point, they're going to be bought out by the partnership. And for that, there's a whole process, valuation considerations and legal implications. I think the takeaway, very simply, is that if the property has been sold, you have X amount of share of the property. So I think it's pretty easy in that case to define like how much equity you're going to get back. And especially if the partnership is dissolved. So now it's a pretty easy transition. But if the partnership is not dissolved because it goes into another property, so now that's where there are a little bit of nuances. But there's nothing overly critical there. There's something to consider. So what about the preparation for exit? Again, you want to show your property under the best angle, the best light possible to prospective buyers. If you have a strong NOI, net operating income, it means you're going to have a higher value with all the other things being identical. So it makes sense to have a strong NOI. Make sure that you're going to work very hard with the property manager to have high occupancy. And the higher the NOI, at the end of the day, the better it will be to obtain new financing, right? Because it's part of the valuation of the property. If the property is appraised for a higher number, then the next buyer will be able to buy for a higher price. Very important. Be aware there are some operators who are going to lower their filters in order to fill properties sometimes. That's why it's important to understand, especially let's say the past few months prior to the sale, take a close look at the applications that are filled by new tenants, and maybe if you can come across the whatever reports, credit score and whatnot, just make sure that they had the bar at 600 and suddenly it goes to 550 just to get the property filled. That's always bad news. Ends up sometimes, or more than sometimes, in evictions. Next, you want to consider capital improvements. So as it wrote here, selective upgrades to increase the property value. It's more like it's about curb appeal. You want to make sure that the property shows well and maybe address any particular deferred maintenance, just to make sure everything is clean. And just make it desirable in general. Finally, here on the preparation for exit, you want to do your own internal legal financial due diligence. Look at the title. There's no lien against the title because somehow a vendor was not paid, and that kind of thing. Also, start working with your CPA to prepare like on the taxes, make sure that everything is paid. Maybe there's I know in some states there's a tax that you have to pay at disposition at sale of a property. So you need to get an idea, an assessment of that tax. And also make sure that all your entity or entities, if you have more than one, they're current, or you have to reinstate them because otherwise it could be a little bit of a legal or logistical concern when it's time to close and transfer title, etc. So sometimes a little bit of a bad surprise there. So
Want me to sign it? No, they have to.
yeah, I'm not sure it was for us. So best practices, start with the end in mind, right? If you've read the 7 Habits, Stephen Covey, that's a very good book that I recommend. But I think that's one of the principles, or one of the things that is mentioned in the book. Start with the end in mind. You have to think about how the exit looks like. And obviously, the exit strategy is part of the business plan, but I would also say that you need to have A, plan B, and plan C, which I think it's a good segue to the next point, because you have to be flexible, right? Because the market can change. We had, in the past few years, we had a global pandemic and followed by higher interest rates and higher inflation. Like there were a lot of things changed, and ideally, you want to be ready to sustain worst case scenarios. As always, we recommend to have sufficient reserves to be able to sustain headwinds. So that's probably like the best strategy there, in case things are not going in the right manner. And arguably right now, we're certainly at a local market bottom, and it's not the ideal situation or ideal conditions for selling a property. And so I think best practice also is, I would say, on regular basis, maybe once a year, talk to your real estate broker, talk to your loan brokers, have an idea, have the property valued, get loan quotes if you are in a variable interest rate environment, just to have an idea. Look at, reassess your exits on a regular basis, in other words. So that's all I have for this presentation. Looking at exits, it's something to really consider and think about the different options that are available to you. Take that into account, different exit strategies into your business plan. That's how you can be prepared to face multiple market situations. I open the floor for any questions you may have, but disposition tax or transfer tax?
What do you?
No, I was
the
talking
name of that
what I
tax
had
you
in
were
mind. It's I know in Tennessee they have an FNE tax, franchise, and what is it, excise tax? And that's something you have to pay. It could be unique to Tennessee, actually.
Okay.
But that's what I was referring. And it could be actually considerable. It's X percent basically of the added value and so on. So if there's a lot of added value, I think we paid on a property. I think on a property, we doubled the property value. Let's see, maybe open or boost. Just to give you an idea. Yes, this one. Yeah, we bought it for 4, we sold it for 9. Did very well. We paid a lot of taxes on this one. on that particular FNE tax in Tennessee. Oops, oh, sorry about that.
You heard that?
It happened to be my. All right.
So are there any questions? You can feel free, reach out to us. There's our contact information and any questions you may have, we'd be happy to, but thank you for joining us. And like I said, if you have any topics of interest, please shoot us an email and we'll do our best to put something together for you.
Great job, guys. Thank
Thank
you.
All right.
for
Thank you,
joining us.
everyone. Have a good
Bye.
evening.
Have a blessed day. Yes.
Take care.
Enjoy.
Bye-bye.
Bye, y'all. Mwah, mwah.
Bye.